Hello and welcome to this session in which we will discuss business combinations, specifically the acquisition method. Now, business combination is a topic that's covered on the CPA exam, and this lecture specifically is designed for people who are studying for the CPA exam. Why am I mentioning this? Because if you need more in-depth explanation, this topic is covered in my advanced accounting course at farhatlectures.com. Now, having said that this is a CPA acquisition method lesson, I go much more in depth than your typical CPA review course like Becker or Gleim or UWord or Miles or Surgeon or any other course out there. So just want to let you know this up front, but if you want more, that's not good enough for you, go to my advanced accounting. Now, a business combination is an event in which one company called the acquirer, the purchaser, buys control over one or more companies known as the acquiree. So simply put, one company buys another company. And there's more than one way to do this business combination that would result in this transaction. We're going to have three specifically I'm going to be discussing, and we're going to focus on one of them as far as we are concerned for the CPA exam. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Hello, my name is Farhat. You are here because you are either an accounting student, a finance student, or someone who's studying for their CMA or CPA exam. Great. You are looking for some additional help, and we can help you. I strongly encourage you to visit my website, farhatlectures.com. I offer additional lectures, resources, including PowerPoint slides, multiple choice questions, in some circumstances, exercises, and true-false questions. Our material is aligned with your CPA review courses, with your CMA review courses, with your college courses. I offer a risk-free trial that you can try to find out whether my website can help you or not. If you find it helpful, you subscribe, you keep your subscription. If not, you cancel and your risk is free. If you like this recording, if you like my lectures, you would like what's on the website, give me a chance to help you with your college courses as well as professional certification. I hope to see you on the website.
The first type of business combination is called statutory merger, is where the acquirer, the purchaser, acquire the assets and the liabilities of the acquiree. What happened as a result? The company that's buying survive while the acquiree ceases to exist as a legal entity. So I buy your assets, I buy your liabilities, you don't have anything anymore. You cease to exist as a legal entity. So you have company A buying company B asset and liabilities, and the outcome is company A. So basically company B is gone, ceased to exist. A case in point is when Bank of America purchased an investment firm called Merrill Lynch. Merrill Lynch ceased to exist, and that was a form of business combination. Statutory consolidation is where an acquirer is created to acquire two or more separate acquirees in their entirety. Here what's happening is you create a new company, and that new company acquires several other companies. So the acquirees, the company that's being purchased, are united under the ownership of a newly created acquirer, and they cease to exist as a separate legal entity. A picture would look something like this. You have company A plus company B, and we have at the end company C. So company C is created to include company A and company B, but both of these companies, basically they're gone. We have company C. For example, Daimler and Chrysler, a German and a US company, they united under Daimler Chrysler, a new company that absorbed both of them. Company C is the newly created company. Now we have the consolidated financial statement, is where we have a parent-sub relationship, is when we have a parent company purchase stocks in another company. Specifically, to have control, you have to own more than 50% of the company's stocks. So you have to own more than 50%. That's usually the case because you do have other circumstances where you have control, but we'll talk about that briefly. But generally speaking, when we talk about control from a financial accounting consolidated financial statement, you have to own more than 50%. Now, Also, if you are a primary beneficiary in a variable business entity, you should consolidate. What is this VIE, variable interest entity? In other words, you may not own 50%, you may own less than 50% and still have control. But that's a topic that we will discuss separately, not today. But in other words, you could have control without having more than 50%. How? Under the various interest entity method. We're not discussing here, just know that it exists. So under the consolidated financial statement, a good example will be the Gap store. The Gap store is a company that owns Old Navy and Banana Republic. So what happened is the Old Navy prepared their own financial statement. Banana Republic prepared their own financial statement. Then what they do, and the Gap store prepare their own financial statement. Then all of these companies prepare consolidated financial statement under the name of GAAP, where they consolidate everything, they combine everything. So all these companies are combined together when you talk about the GAAP, because the GAAP store is the parent of Old Navy and Banana Republic. They are the parent companies. Now, could you own more than 50% and still not have control? Yes, that could happen. What's an exception is when the subsidiary is in bankruptcy. When the company that you purchase more than 50% of a particular company, you are in control of that company. But that company is in legal or reorganization or bankruptcy. Who's in charge? Most likely a court or someone, a trustee appointed by the court. Then you're no longer in charge of that company. Under those circumstances, you don't consolidate. And the reason I mentioned this, what if you saw this question on the CPA exam? Under what circumstances you don't have to consolidate? Well, if the subsidiary is in legal organization or bankruptcy, then you're out. You don't control it. Now let's take a look at investments and equity securities. How does it work? Well, as I mentioned, first you have to acquire more than 50% up to obviously 100%. You cannot buy more than 100%. You would use something called the acquisition method. And specifically, the term is important because it's not the pooling method, it's not the purchasing method. The method is called acquisition method to account for these investments when you consolidate. Well, great. As a result of the acquisition, the parent company acquires total assets and total liabilities. Now, keep in mind, whether you own 51% or 100%, the assumption is once you go over 50, you own 100%. And it's very important, the value is the date of the acquisition, not the announcement date. So we would look at the date of the acquisition, what happened on that date, not the date of announcement. So acquisition date is represent the date which the company obtains control over the sub net asset, which is the sub's equity. The acquisition date sometimes referred to as the measurement date. It's the date that you measured the transaction, or the date at which the acquired identifiable assets and liabilities assumed are measured at fair value and the acquirers began to recognize revenues and expenses and the acquiree in the consolidated financial statements. So when do you start to count revenues and expenses? When you acquire the company, acquisition date, not when you announce. You could announce and it may take 3 to 6 months before the transaction closes. Now you have to pay a price for your purchase. So let's take a look at the initial cost of the investment. How do you record this investment initially? Well, what is it equal to? It's equal to how much you gave up. The cost of the investment equal to the fair value of the consideration paid by the investor, by the company buying, by the acquirer, by the parent company. How much did you pay? Now, what can you pay? Well, obviously, you can pay cash. You can also issue stocks. So rather than paying cash to acquire the other company, you can give them stocks. A case in point is Microsoft and LinkedIn. When Microsoft purchased LinkedIn, they gave LinkedIn shareholders stocks of Microsoft. They didn't give them cash. They say, okay, here's now, rather than having LinkedIn stocks, give us your stocks and we'll give you Microsoft stocks. So that could happen. Sometimes you could assume the liabilities. They have liabilities, you have to assume the liabilities. Or there could be a combination of all these issues. So this is what all these methods. So this is what a journal entry would look like. You will debit the investment in the sub for how much you paid. You debit legal expenses if you have any legal expenses. You credit common stock if you issued stocks of your company. And how much do you credit common stock? Remember that rule, number of shares, the formula, not rule, times the par value. And anything over par value, you would credit additional paid-in capital. Obviously, you will credit cash or assets. Sometimes you might give other assets, who knows, a warehouse, inventory, whatever you gave the seller, you have to credit, give it to them. And you have to credit any liabilities if you assumed or incur any liabilities in this transaction. This is the initial cost. Now, keep in mind, some shareholders of the company that you're purchasing may not want to sell. So for example, you have two shareholders. One owns 7.5% and the other owns 7.5%. So in total, we have 15% that they don't want to give up their interest. You say, we're not selling. What do we call these group of investors? Minority interest or non-controlling interest. Use NCI better, non-controlling interest. When the parent company acquires less than 100%, the difference between the sub's total equity and the share acquired is attributed to other shareholders that would not have a controlling interest in the subsidiaries. So they still own shares in the subsidiaries, but guess what? They have no controlling interests. They have no saying in the company. That's why we call them the NCI group. At the date of the acquisition, the non-controlling interest is computed. We have to compute the value of the non-controlling interest. And how do we do that? As the fair value of the sub at that date times the percentage of the non-controlling interest. So we have to figure out what was the fair value of the sub times 15% in our situation. And it's reported as a separate line item on the balance sheet. So on the balance sheet, we'll have NCI as a separate line item. So the fair value of the sub equal to the parent acquisition cost. It could include contingent consideration. We don't have to worry about this. And the fair value of the non-controlling interest, because both of them together equal to the total fair value, because it's the controlling and the non-controlling that form the whole company. So the value of the non-controlling interest is accounted for separately, and you will see how later on it's increase and decrease to account for the proportionate share of the sub's income and dividend. So what's going to happen, whatever dollar amount we assign to this 15%, this dollar amount will go up and will go down as the subsidiary generate income or pay dividend. Now, the best way to illustrate this is to actually look at an example, just to kind of show you how this all fits together. On February 2nd, year one, Company X announced its decision to acquire 90% of the par value of the common stock of Company Y. So X is buying Y. And how are they doing that? By issuing 20,000 shares of their $15 par value stock. It's traded at $40. Remember, this is the announcement date. If we are taking the announcement date, 20,000 shares times $40 equal to 800,000. But this is the announcement date. The acquisition took place over a year later, March 15, year 2, when the stock price was $45. Well, it means now we paid $900,000 to buy 90% of Company Y, because what matters is not when we made the announcement. What matters is when we actually acquired their stock. So to prepare the journal entry, first thing we have to know, how much did we pay for the company? We paid for the company $900,000 because we gave them 20,000 shares, and on the acquisition date, our stock was trading for $45. Now let's take a look at the journal entry. Well, we debit investment in sub $900,000. Well, if we paid cash, we'd have credited cash $900,000, but we issued stocks. We credit common stock, number of shares times the par value. This is the $300,000. And anything left, you got it. It's plug. Additional paid in capital is $600,000. It's called additional paid in capital. It's called capital surplus, whatever you want to call it. Just know that it's the excess. Now, if this company don't have a par value, what would happen is we debit investment and we credit common stock for $900,000 because we don't have additional paid in capital. Pretty straightforward. Remember, I said that some people don't sell their shares. Let's assume two shareholders, just for the sake of simplicity. One owns 9% and the other one owns 1%. So there's 10% that they don't want to give up they don't want to be sold to us. Now we have to compute the their value. The non-controlling interest is computed as the total fair value of the sub at the acquisition date times the percentage of the non-controlling interest. Well, with the fair value of the sub being equal to the parent's acquisition plus non-controlling interest, because the total value, we have to look at what's the implied total value and multiply it by 10%. In our situation, we paid $900,000 for 90%. What are we implying? We're implying that the total value of the company is $1 million. If you watch Shark Tank, that's what they do. It's say, okay, you want to pay $900,000 for 90%. That means your company is worth $1 million. So what they do, they take, to make it more realistic, what happened on Shark Tank, if you watch that show, and you should if you don't, it's really, I love that show. It's really business. So let's assume an entrepreneur comes and they want to raise $250,000, and they want to, you give them $250,000 and they will give you 10% of the company. What are they implying? They're implying that their company is worth $2.5 million. That's what they're implying. And this is what we're implying here. 900,000 divided by 90%. It means the company is worth $1 million. So they take the dollar amount that you are asking for divided by the percentage you're giving them. It means the company is worth 2.5. If you pay them 250, that's 10% of the company. Just make sure you know this. So the fair value of the non-controlling interest, the total value of the company, is $1 million. The non-controlling interest together, they own 10%. 100,000. Now what do we do with this 100,000? It's a new line on the balance sheet under the equity section. And what's going to happen to this 100,000? It's going to go up and it's going to go down as the subsidiary earns income. We're going to see why earned 270 and they distributed 210 in dividend. So what's going to happen is this: at the end of the year, we're going to take 270,000 in net income times 10%. And we're going to increase the NCI by 27,000. Now NCI goes down by dividend because of the company paying dividend. It's paying dividend out of their company. They pay $210,000 in dividend, 10%. Their share is decreased by 21,000. Therefore, the ending non-controlling interest is 106. Now, some of the CPA exam questions, they could ask you, what is the non-controlling interest as of March 15th? That's the answer. They could ask you, what is the controlling interest as of December 31st? 106. They could ask you about the net change of the non-controlling interest plus 6,000, the difference between the income and the dividend. So you could be asked many questions about NCI. Make sure you know how to solve this. Now, how do you consolidate? No pun intended. This topic, you go to Farhat lectures, you work more MCQs, you look at additional lectures, resources that's going to help you prepare for your CPA exam. Invest in yourself. Good luck. And of course, stay safe.